European debt crisis, a decade of financial turmoil, 2009 to 2019. The European debt crisis, spanning from 2009 to 2019, was one of the most pivotal economic challenges faced by the European Union, EU, in its history. While the financial turmoil began in the wake of the 2008 global financial crisis, its consequences reverberated across Europe for nearly a decade. The crisis not only tested the economic resilience of Eurozone countries, but also put the cohesion of the European project to the ultimate test. The debt crisis, which involved several countries facing unsustainable debt levels, also exposed significant flaws in the Eurozone structure and the EU's economic governance. Understanding the European debt crisis requires examining its origins, key events, responses, and long-term impacts, as well as the lessons that have shaped the future of Europe's economic policy. This video explores these aspects in depth, shedding light on how Europe endured and emerged from a period of immense financial instability. Origins of the crisis, the precursor of global financial uncertainty. The European debt crisis did not appear in isolation. It was the result of years of economic and fiscal mismanagement in several European countries, compounded by the global financial crash of 2007 to 2008. When the financial system imploded, it triggered a severe recession across the globe. Countries around the world, including those within the Eurozone, faced deepening recessions, banking crises, and government debts soaring to unsustainable levels. Before the global financial crisis, many Eurozone countries had already accumulated significant public debt. Greece, in particular, had long struggled with budget deficits and high borrowing. Despite being a member of the European Union, Greece had largely ignored fiscal rules that were intended to keep debt levels in check. The financial turmoil, combined with Greece's pre-existing debt problems, led to a situation where the country was at risk of defaulting on its debt obligations. Several other European countries were also exposed to the vulnerabilities of high debt. Portugal, Spain, Ireland, and Italy were among those that faced deteriorating fiscal health as the global recession impacted their economies. These nations had built up large public deficits and relied heavily on external borrowing, making them particularly vulnerable when global financial markets tightened. The situation in these countries, especially Greece, escalated into a full-blown debt crisis as their ability to refinance debt and service their obligations became increasingly questionable. The immediate response, bailouts, and austerity. The early years of the European debt crisis were marked by a response from the European Union, the European Central Bank, ECB, and the International Monetary Fund, IMF, in the form of bailout programs and austerity measures. The first significant bailout package was agreed upon in May 2010, when Greece received a €110 billion financial rescue package. In exchange, the Greek government committed to implementing stringent austerity measures designed to reduce its debt levels, increase revenue, and cut public sector spending. These measures included tax hikes, pension cuts, and labor market reforms aimed at reducing the budget deficit. However, Greece was far from the only country that required financial assistance. Ireland, Portugal, and later Spain also needed help to stabilize their economies and manage their debt. By 2011, Ireland had signed a €67.5 billion bailout deal with the EU and the IMF, followed by Portugal in May 2011, which received a €78 billion rescue package. Spain was not bailed out directly, but its banking sector required assistance, leading to a €41 billion loan for its troubled banks in 2012. The austerity measures attached to these bailout packages, however, proved to be one of the most controversial aspects of the crisis. While EU leaders argued that fiscal consolidation and structural reforms were necessary to restore economic stability, critics believe these policies were counterproductive. By slashing government spending and increasing taxes, austerity only deepened the recessions in the countries affected. Unemployment skyrocketed, particularly in southern European countries, and social unrest spread across the continent. In Greece, violent protests became a frequent sight as citizens grew increasingly disillusioned with their government's failure to protect their living standards. In particular, Greece, which had already been facing severe economic problems before the crisis, saw its unemployment rate rise to record levels, peaking at 27.5% in 2013. Youth unemployment was even worse, with nearly 60% of young people out of work. These socio-economic strains gave rise to political instability, as populist and anti-austerity movements gained traction in the form of parties like Syriza in Greece and Podemos in Spain. The political fallout of the crisis further destabilized these countries, as austerity measures undermined public trust in the political elites and led to shifts toward more radical political factions. The role of the European Central Bank and the rescue mechanisms. Amidst the crisis, the European Central Bank, ECB, became a critical player in stabilizing the financial system. While the ECB was initially reluctant to intervene in the crisis, it eventually became more aggressive in its monetary policy response. In 2012, ECB President Mario Draghi famously pledged to do whatever it takes to preserve the euro, signaling the central bank's commitment to supporting the single currency. The ECB's first major move was to implement the Outright Monetary Transactions (OMT) program, which allowed the central bank to purchase government bonds from struggling Eurozone countries, thus providing liquidity and reducing borrowing costs for countries like Spain and Italy. These measures were instrumental in preventing a complete collapse of the banking sector and stabilizing bond markets. In addition to its monetary policy actions, the European Union also established new mechanisms to support struggling economies. The European Stability Mechanism, ESM, created in 2012, provided a permanent bailout fund with a lending capacity of up to 500 billion euros. The ESM played an essential role in mitigating the impact of the debt crisis, ensuring that countries in trouble had access to financial support without triggering defaults or leaving the Eurozone. Political and social consequences. The European debt crisis also had profound political consequences. The austerity measures imposed by the EU and the IMF have led to significant political unrest in several countries. Greece, in particular, experienced political turmoil with the rise of the left-wing Syriza party, which campaigned on a platform of rejecting austerity. In January 2015, Syriza won the Greek elections, and the new government, led by Prime Minister Alexis Tsipras, engaged in a tense standoff with the EU over the terms of the bailout agreement. This led to a dramatic series of events, including a referendum in July 2015, where the Greek people voted against austerity measures, further straining Greece's relationship with its EU partners. Populist and anti-EU movements also gained momentum across the continent. In Spain, the Podemos party rose in prominence, advocating for an end to austerity and greater political and economic reforms. Meanwhile, in Italy, the rise of the Five-Star Movement signaled growing dissatisfaction with the EU and its handling of the crisis. The rise of Eurosceptic sentiment was not limited to Southern Europe. Many in the UK were also disillusioned with the EU's role in the crisis. This ultimately played a part in the Brexit referendum of 2016, where a majority of British voters chose to leave the European Union, citing concerns over economic governance and the handling of the debt crisis. Recovery and lessons learned. By 2019, the immediate effects of the European debt crisis had largely subsided. Most of the countries involved in bailout programs had managed to return to growth, albeit at a slow pace. Greece, for instance, emerged from its final bailout in 2018, and Portugal and Ireland had both made significant strides toward recovery. However, the economic scars left by the crisis remained. Unemployment rates in Southern Europe remained high, and the economic divide between the Eurozone's northern and southern countries persisted. The political landscape was also deeply affected by the crisis, with populist and anti-EU sentiments continuing to challenge traditional political structures. One of the key lessons learned from the crisis was the need for stronger fiscal integration within the Eurozone. The inability of individual countries to devalue their currency and adjust their monetary policies during the crisis exposed the lack of fiscal tools available to deal with national crises. Moving forward, the EU has taken steps to deepen its economic integration, including the creation of a banking union and discussions about the possibility of a common fiscal policy, although challenges remain. The European debt crisis of 2009 to 2019 was a defining event for the European Union, revealing both the strengths and weaknesses of the Eurozone. While the crisis posed an existential threat to the EU and its single currency, it also led to crucial reforms that have shaped Europe's financial governance moving forward. Despite the painful austerity measures and the political upheaval that followed, Europe managed to stabilize its economy and emerge from the crisis. Yet, the legacy of the crisis continues to influence European politics, economics, and the very nature of European integration. The lessons learned from the European debt crisis will be vital in ensuring that Europe remains resilient in the face of future financial challenges. Thanks for watching. If you enjoyed this video, please like, subscribe, and hit the bell icon so you never miss an update. Drop a comment with your thoughts, and I'll see you in the next one.